Are we good? Or you guys don't want to talk to me because you wrote a test? How was the test? I haven't started marking, so it's not a trick question or anything. I'm gonna start this weekend. Probably be done this weekend as well. Did your last minute engagement with me help? Not at all. It was rubbish. What, they asked too much theory?
Yeah.
So, yeah. How did you guys find the ratios?
Of all the ratios they could have asked.
Mm-hmm.
Yeah, of all the ratios.
All right. Well, hopefully it went well. We'll see what happens. Okay. So let's get into today's lecture. As you guys know, we're now in Unit 4. Okay, and we're actually we should finish Unit 4 today. It really isn't anything too hectic. I'm sure you've also noticed that I've given you guys 3 ICE tasks. Yeah? But yeah, those are due for Friday, midnight next week. Okay? But we'll talk more about those later on. I think now let's get into Unit 4. Introduction to Managerial Accounting. Okay. All right. Now, first thing that they want to bring to our attention is that one of the biggest mistakes that businesses can potentially make is understating their costs or miscalculating their costs. Why? Because if you miscalculate your cost, chances are you're going to then quote the wrong selling price to your customers. Okay? Are you coming in? Yes. Okay. All right. So that's one of the biggest mistakes that you can make. Think about it. If you think that your product costs you 10 Rand, I just like to use simple figures for the sake of obviously driving home the point. If you think your product costs you 10 Rand, right? But then it actually costs you 15 or 12 Rand 50, okay? Obviously that's gonna hurt you if you then say, okay, my selling price, I just want it to be 5 Rand above my cost, okay? So in your mind, you'll be thinking that you're earning 5 Rand profit based on your 10 Rand estimated cost, but in actuality, you're only earning 2 Rand 50, and I'm sure that'll also affect your budget for the things you thought you could afford, but in actuality, you can't, okay? The financial manager has to ensure that all costs are taken into account when calculating the cost of sales, okay? So, in essence, they need to really make sure that they're getting it right. And then break-even points are used by the financial manager to determine how many goods have to be sold in order for a business to be run on a profitable basis. Okay, I think a lot of you probably have already come across the term break-even, but then for those of you who haven't, okay, we're going to learn more about it in 2B. All right, finance 2D, but for here and now, break-even is basically that point at which you're either making a profit or a loss, okay? In other words, your income is equal to your expenses, okay? That's the break-even point, all right? Costing your product. It is every business's prerogative to determine the total cost in producing the product it wishes to sell. Okay, the cost of a product can be classified into the following main categories: production costs, all right, also known as manufacturing costs, or non-manufacturing costs. Okay, non-manufacturing costs, you'll be talking about administrative costs, you'll be talking about selling and distribution costs. Okay, so things like your advertising would fall into that. All right, now when it comes to production costs, you're looking at 3 main things, all right, direct materials. That's the materials we use in our product, all right, to produce our final product. Then there's direct labor. These are the guys who obviously have to stitch our sneakers together. For example, if we were in the production of Nikes or whatever type of shoes. And then manufacturing overheads, okay? Manufacturing overheads, okay? All right, then there they just begin to speak to direct materials, all right, refer to the materials which can be traced directly to the finished product, okay? So for instance, wood for wooden chairs, okay? It is therefore important to note that direct material will be a variable cost, okay? What is a variable cost? A variable cost is a cost that will increase based on the number of units that we actually produce, okay? It's dependent on how many units that we produce. If we produce 0 final products, then obviously we're going to have 0 variable costs, okay? Right. Yes, so there it says, it is therefore important to note that direct material will be a variable cost because it will increase in direct proportion to the number of units produced, okay? That's just basically saying exactly what I've shared with you, but in a more academic and eloquent manner. The cost of direct materials excludes the cost of small quantities of materials that cannot be clearly identified in the final product, okay? So things like glue, for instance, all right? These small little things that we use, but we can't immediately identify, okay? We would then term those as indirect, okay? A lot of the time you also find that those type of materials would also be used for other things, all right? For instance, we also use glue to stick papers together or to do some other functions, all right? So we can't necessarily just say, okay, that specific material is something that we have used strictly for our product, okay? But let's move on. I'm sure we get the point. Then direct labor refers to the cost incurred to remunerate workers that are directly involved, all right, in the manufacturing process. Okay, that's why we call it direct labor. Again, this is a variable cost because what? It's focused on the product, okay? The manufacturing of the product, okay? Then they're just using examples of costs that would not be included in direct labor, such as your supervisors, your managers, cleaning teams, security staff, and the like. The remuneration of such people is regarded as indirect labor and will form part of the manufacturing overheads. Okay, cool. Then let's proceed. Now they're speaking to manufacturing overheads. Okay, the term used to describe all the other manufacturing costs incurred in the production of the finished product. Only manufacturing costs must be included in this figure. Okay, take note of that. All right, and then it goes on to say, therefore, administrative, marketing, distribution costs should be excluded from this category. The following costs are included under manufacturing overheads. So that's where we now begin to incorporate our indirect labor, our indirect materials, all right? Rent paid for the factory where we're actually producing these goods, okay? Maintenance for the machinery and equipment that we're using for these goods. Depreciation, all right, for the factory equipment that we're using again for these goods. Water and electricity, insurance, and then cost of quality control. Right, and then here they're highlighting something very important. Manufacturing overheads can be fixed or variable, or they can actually be both, okay? So take note of that. Take note of that, okay? Now they're going on to speak about non-production costs, okay? Non-production costs, and as we highlighted earlier, these would typically either fall into administrative costs or marketing, distribution, and selling costs. Okay, administrative costs, these are the typical things that need to take place in your organization. So there they say are all organizational, executive, and electrical costs associated with the general management of the organization. So these are very general things, okay? Insurance, water, and electricity, stationery. We need to obviously cater to these costs in order to take care of the overall business. Okay, we can't necessarily say this insurance is strictly as a result thereof of this product. No, we have insurance on the whole building, all right? Water and electricity, obviously, we cannot do anything in the office without that. Stationery, we need our printers, we need our pens and pencils and etc. in order to obviously go through all of our day-to-day functions, all right? Then marketing, distribution, and selling costs, pretty straightforward, all right? These are obviously costs that we incur in order to sell to our customers, okay? All right, or at least that's their objective, okay? Then sources of information in the costing process. All right, so in your textbooks, I think this is something just worth having a look at. It's not entirely extremely important, but I think it's something worth having a look at. So let's do that. Again, you guys, page for this might be very different. Okay, so it's that table right at the bottom, and 4.2.3 source of information in the costing process. Okay, and this just helps you to find out, okay, what are the source documents, things that we can, oh, it's a different page, it's going to be a different page. So if you look for non-production costs, 4.2.2. Okay. Yes, that's the one I'm looking at. What page is that in the book? 98. Okay, so it might be page 98 in some of your textbooks. Okay. So this is just showing you, okay, if we wanted to identify our direct materials, all right, if we wanted to identify our direct labor, these are the type of documents you could have a look at. All right, your clock cards, all right, for direct labor, your personal files of the laborers, your payroll, okay, all right. So I just thought that would be worth obviously just mentioning, all right. But let's proceed. Okay. Then, when it comes to costs, we can categorize them into two. Whatever costs can typically be categorized either into product costs or period costs. Okay, product costs, obviously, these are the costs that we would then recognize, or should I say, incur in the production of the actual product. Okay, and not only just in the production, but getting that product ready for sale. Okay, this would typically make up your cost of sales. Okay, for those of you who remember from accounting. Okay, then we also have period costs. Now, period costs obviously would pertain to a certain time frame. Okay, and here that's when you'd be talking about things like rent. Okay, things like salaries, that obviously they all pertain to specific periods. And then now the other thing to also recognize about period costs is that these are the type of costs that you will then find on your statement of comprehensive income or your profit and loss account. Okay. All right. All right. Okay. Right, and then the next thing that they talk about there is just controllable and uncontrollable costs. And in your textbooks, I see they also refer to it as sunk costs. Okay, sunk costs. All right, sunk costs are costs that they're going to be incurred or they've been incurred. There's nothing we can do about it. So, for instance, during this whole COVID debacle, there's a lot of companies that obviously had already gotten into leases. All right. So obviously they had committed for the next 5 years, the next 3 years to be renting a building there in Sandton. Okay. As a result, workers are not coming to the office. There's nothing they can do about that. It's a sunk cost. It's something that they have already committed to. Okay. Then, so basically, there's nothing that managers can really do about uncontrollable costs. Okay. And then, however, of course, controllable costs, it's self-explanatory. There is some level of control that you have over those. You can make decisions over those. Okay. Then opportunity cost. I'm sure you guys, some of you have heard of opportunity cost before. That is basically the next best alternative, not chosen. Okay. As I'm sure you guys have learned in economics at this point, we have unlimited wants, all right, but limited resources. Okay. Whether we're talking as individuals or whether we're talking as a company, that is our reality. Okay. Now, being that the case, right? Whenever we make a decision, for instance, if we say, I'm going to go to Sun City for holiday as opposed to going to Durban or Cape Town, all right? Let's just pick one. Let's just say, as opposed to going to Cape Town, all right? That next best alternative was going to Cape Town, all right? You forego that, okay? Another example that we can use, coming back to business, is, okay, us committing to bringing on an executive to our business, all right? That means that we will not be able to bring in the latest technology, for example, okay? So we have foregone the opportunity to obviously bring in the latest technology to our business. Okay, that's our next best choice that we have lost out on. Okay. All right. Let's just see what are they saying in this last paragraph. In real life, it will be the cost of choosing to study full time and giving up the opportunity of work. The opportunity cost will be the salary given up. In business, it may be the cost of buying a machine instead of leasing it. Okay. All right. All right. So just one or two other examples of that. Then we have fixed costs and we have variable costs. Okay. Fixed costs are literally costs that they do not change based on our level of production. Okay. So if we're in the business of let's say we're wise books. We're in the business of selling textbooks. Okay? Our costs in relation to paper, for example, will increase based on how many books we obviously produce. Okay? Can you see that's a variable cost? It depends on how much we produced. All right? That will determine how much it actually is. Rent, however, all right, is going to remain at 5,000 regardless of how many books we actually produce. And you see that that's a fixed cost, okay? So those are the two different main. Sometimes you get actually semi-fixed, all right? That means it has a variable component and a fixed component within it. An example of that would be, these days, most homes actually don't have a home line, all right? But back in the day, what you would have is that Telkom would say, okay, for having a telephone line in your house, you're going to pay 1,000, okay? And then if you make more than, who knows, 20 calls in a month or whatever number that is, they will then begin to charge you additionally. All right, or maybe it might also be based on time, how much time you actually spend on the phone. If you exceed this amount of time on the phone, then we will charge you per minute for the number of minutes you've actually exceeded past this actual amount of minutes. So can you see that there's a fixed portion in that, that being the 500, and then there's a variable portion based on either how many calls you've made or based on how much time you've spent on the phone, okay? So that's just a practical example of that. But I think for this module, I don't think they talk about semi-variable. I think it's only in the next one. Okay, but I thought might as well mention it now. Okay, I think we've mentioned everything in relation to that. Just a few more examples on fixed costs. You've got property tax, you've got insurance, you've got administrative overheads. Okay, your salaries, for example. Your salaries is not going to change just because you didn't manage to produce any textbooks. Okay, still going to need to pay your bookkeeper, what you've agreed in the contract, and your receptionist, etc., etc. Okay, and then this is just a nice little table that you can use to understand, okay, with the changes in my production, how does that impact my variable costs, okay, right? And likewise for fixed costs, okay? Something you guys can obviously then look at in your own time. Then they begin to speak about the break-even analysis, all right? And this break-even concept falls into a bigger concept called cost volume profit analysis, okay? And like I told you, break-even is a concept which describes the point at which neither a profit or a loss is generated. Because literally the money we've generated is equal to our expenses, okay? It will indicate how many units of a product need to be sold before we start making profits. Okay, there's two types of break-even points that you can calculate. You can calculate how many units do I need to produce and sell, by the way. Produce and sell in order to not make a loss, all right, or a profit. Or you can calculate the rand value amount of how much revenue you need to realize in order to ensure that you cater to all your costs. Okay, right. Typically, decisions or situations where cost volume profit analysis could be included, determining the break-even point, determining how much the expected turnover exceeds the break-even point. All right. So if we want to target how much profit or how much money we want to go home with, all right, or how much we want the business to generate over and above our expenses, we can then use the break-even formula to actually identify that. Another thing that we can do is to say, if our revenue is to fall, by how much can we allow it to fall before we reach our break-even point? And that's what we call the margin of safety. All right. It shows by how much the expected sales can decline without business suffering losses. Okay. So this is just to help us be proactive to say, okay, fine. Whoa, COVID-19 has taken place. Okay. How much sales do we need to ensure that how much sales can we begin to continue to, not begin, but continue to lose before we are at break even? All right. This helps us to know, okay, we need to make sure that we are at least hitting this amount of sales, all right? At this amount of sales, then we know, okay, cool. We're still going to be able to meet our expenditure. Anything less than that, there's no more safety. We're going to be making losses, okay? Assessing the implications of cost hikes and reduction in profits, okay? They're still speaking to the overall cost volume profit analysis, and I think we do more of this in 2B. Discussions regarding determination of selling price, okay? Right. Yeah, so this would obviously influence your selling price, because if you drop your selling price, then obviously consumers are more likely to buy more, right? Because the cheaper the price, usually the product becomes more attractive. Okay. So then the final point there, cost volume profit analysis may be used to indicate the expected profit for the various alternatives, okay? A lot of the time we're using this for sensitivity analysis to say, if we do this, how is that going to impact our profit or our break even, all right? If we do this, how is that going to impact us in terms of the number of units we actually manage to sell, okay? So this is usually done with a lot of additional information. So you typically know already how sensitive your customers are to price increase or price decrease, okay? All right. Marginal cost is defined as the sum of variable costs, okay? So basically your materials, direct materials, your direct labor, and then obviously finally your, what is this, manufacturing overhead, assuming the variable portion, assuming if it's both fixed and variable, okay? We'd only take that variable portion, all right? This concept is useful because it incorporates all cost items which vary in direct proportion to volume, all right? And when they say volume, they mean volume of units that you've obviously produced. All right, marginal income is then the opposite of that. It's the revenue that we're going to realize, okay, after deducting our variable, our total variable cost, in other words, our marginal cost from our selling price. Okay, that's what marginal income is. Okay, this is the difference between sales, right, selling price, and marginal cost. Okay, and again, marginal cost is the total variable cost that we're going to incur. And then we have a formula there, marginal cost ratio. All right, so here you're saying what is our marginal cost divided by our sales. Okay, you can also get your marginal income ratio. Okay, and that would then be your marginal income again, but divided by sales. Okay. And we're going to see where we're going to actually use that. Okay, so there's our saying, you get marginal income as well, ratio. Okay, and then the final formula that we obviously need to be aware of is that of net profit, okay, or net income ratio. All right, and there literally it's your net income divided by, your net profit divided by your sales times 100%. Okay. Cool. Is that it? Okay, so here now they're telling us how you actually calculate break-even. So break-even point in units. Remember I told you there's two break-even points that you could calculate. Break-even point in units or break-even point in sales revenue. Okay. All right. So it's two sides of the same coin, really. So your total fixed cost divided by your marginal income per unit. All right. So in other words, your selling price minus your variable cost. Then you'd have your marginal income per unit. All right. Then the second one, break-even point in sales. You got your total fixed cost divided by your marginal income ratio this time. Okay. So there you just need to take that extra step to say, okay, selling price minus my variable cost divided by my selling price. Then you get your marginal income ratio, okay? And then you would get your, then you can do that formula. Then break-even point in sales revenue. If, for instance, you're a bit shaky, all right, on the second formula there in red, what you can do is just get your break-even point in units and then times it by your selling price, and then you get your break-even point in sales revenue. Okay, but then, yeah, you must just be careful. No. Yeah, okay. No, that's fine. But yeah, you must just not be careful because sometimes they might actually leave out certain key information, so you might get stuck there if you don't know how to do it. With the formula in red there. I'm trying to think what information they could, because either way you'd still need to be given most of that, unless they give you the actual marginal income ratio and the actual marginal income, but they don't actually give you the selling price. That's where you may get stuck. But I mean, then if they give you the marginal income ratio, then you should be fine. Because then, yeah, you should be fine. Okay. But yeah, just be careful there, because it cost, volume, profit analysis only gets tricky when because there might be different ways to skin the cat, but if they leave out certain information, that limits the different ways of skinning the cat. So if you get too used to calculating it one way and you don't know the other way, then you might just get stuck. Okay. But otherwise, it's fairly simple, fairly straightforward. I don't know if there were any questions, thoughts along the way. But yeah, theoretically, really, that is your unit 4. That is your unit 4. Okay. So there's only 2 exercises that I want us to do for unit 4. But I think the best thing to do now, because I'm sure you've just been listening and listening and looking at slides this whole time, is for us to actually just take a quick break. And when we get back, we're going to do exercise 2.4 and 2.6, and then we will take it from there.